What's good, everybody? It's Z from The Mask, and today I'm going to make a video at popular request from the server about the strategy that I currently use on NAS100 for my trading company, right? Some of you may know I have a client account where I trade money for other people, similar to a hedge fund, just on a very small level compared to what Wall Street is doing. I'm going to teach you the strategy that I use on NAS100 in order to have achieved in the last about 4 months a 162% gain trading only NASDAQ. This is a strategy that doesn't rely on higher time frame or top-down analysis or any of that. There's no mechanical edge. There's none of this complicated garbage, okay? It is simply some 4th grade math that decides when you buy and how often you buy. Now, the core system here is pretty simple. We rely on something like NAS100, US 30, the gold ounce, the S&P 500, an asset class that only goes up in value. If you go to the daily time frame here on NASDAQ real quick, right? In the overall grand scheme of things, NASDAQ has only gone up, right? You can see that. Sure, there is corrections to the downside. Okay, I'm not denying that. But that's exactly what we're using in this strategy. We want those corrections while knowing that overall it is guaranteed to go up over time. That is exactly what we rely on. Now, what this system does, I'm just going to show it on the 5-minute time frame, and then as an example, and then I'm going to do the math with you on the daily time frame to see how you can actually trade this. So what this system basically relies on is just having a buy without a stop loss, okay? Because again, NAS is guaranteed to go up, so we don't need a stop loss. It's basically like investing. You don't have a stop loss when you're investing. You have a buy position, and you simply wait for a correction, some kind of aggressive downwards move. So you see you have something like this, right? So let's say somewhere here, I say, oh, I want to buy at 650. Okay, and I place a buy position there. Remember, we don't have a stop loss. And then from there, this is my initial position. Okay, this is my initial position. So wherever you are in the market, wait for a nice correction to the downside, some kind of downwards move. Okay. And then once you've seen a downwards move of at least about 100 to 200 points, somewhere down there, you can place your first buy position. And this is the position from which you will do all of your math, okay? This position, now that it's dropped, let's say 200 points. Now, in this instance, we've only dropped about 60 points because it's early on in the day. And overall, we've been going up quite aggressively. So we're not seeing a whole lot of downwards movement. But pretend for a second, okay? Just pretend that this is a 200-point move to the downside. And you buy down here, okay? Then what you're going to do is put a target 100 or 200 points above that. Let's just say 100 for now. You put a target at 100 right there. And now what you do is do your math based on this, okay? Before you place this order, just let's do some math before you place the order. If the market is, let's say, right here, okay? If the market is right here and you're looking at a price of 22,700, you know that you would enter your buy position 200 points below that, somewhere down here at 500, right? You know that this is where you will buy with your target at 100 points. What you do from here, this price is now your mathematical level, okay? You take this 22,500 and you go to the daily time frame. This will only happen once, by the way. All future is literally just copy and pasting numbers. This will only happen once. And you look for a level, some kind of major psychological level, like down here at 15,000 or down here at 12,000 or 10,000. You need some kind of major level that you do not believe the market will ever return to. Me personally, on my, like hedge fund or whatever you want to call it, I chose a level of 15,000. I personally do not believe that the price will ever come back down to 15,000. So I do my math based on a price of 15,000. So if we measure from here, from 15,000 up until 22,500, which if you remember is the number or the price where you want to buy your first position, that is a difference of 7,500 points. 7,500 points is now the point amount that we want to multiply with our trade size. So if you're using the same broker that I am, which is Fusion Markets, they are an Australian broker. They have a little purple F logo if you're going to look for them. They're called Fusion Markets. Their trade size on NASDAQ, or their contract size on NASDAQ, works out in a way to where, oh, my fault, 0.01 lots equals $0.01 per point on NAS100. This is just how Fusion Markets works out. If you have a different broker, it will probably work out in the way that it is $1.0 per point on NASDAQ. This is mine on Fusion Markets, and this will most likely be the one on a majority of other brokers. Now what you do from there, once you know how much money you are going to lose per point or gain per point, you can do the math of the minimum required balance to trade this strategy. So in my case here, we would simply multiply 7,500 points. Okay, we take our 7,500 points, multiply it by 1 cent per 0.01 lots. Okay. So what we would do is multiply 7,500 by 1 cent, so 7,500 cents. And then what we do from there, simply divide that by 100 to get the dollar amount. So we have, what we can do effectively is just take our 7,500 and turn it into $75. This means if I were to buy at 22,500 and go down all the way to 15,000, I would lose $75. But again, I don't believe it will ever go down to 15,000, which means I can make my entire balance, my entire account balance, the stop loss. If I now, let's say, have a balance of $100, $100 like that, the price would now need to drop from 22,500 all the way to 12,500 for me to lose my money. If the market is never going to come back to 15,000, I'm never going to lose this account. I can just wait for it to go back up. Now, if I have let's say if I have two positions in here instead, or I have $200, I can then afford to multiply this, well, by 2, like that, to have $150 of potential loss, but on a balance of now $200, which means if we go back to the 5-minute time frame here, what we can then do is place another buy position somewhere down here. Again, no stop loss, place it somewhere down here, and the same exact target. The further the price drops down and the larger your balance is, the more trades you can open as the price keeps dropping down and down and down and down. And when it eventually, inevitably recovers, you will make more money. So we're going to do some quick, simple math here, okay? Just to teach you the concept. Let's say your initial buy is at 22,500, right? And your target is at 22,600. That equals a 100-point profit, 100 points of profit, right? If your second position is now at 22,000, but you still have the same target at 22,600 because you obviously believe that it's going to go back up to that, now all of a sudden you're making 600 points. And the next one might be at 21,500, okay? But now the same 22,600 very quickly turns into 1,100 points. So if you only have a $100 balance, you can only afford to make a 100-point profit. But if you have a $200 balance, you can afford to make 600 points of profit. You see how that isn't just double the points? Even though you only doubled your balance, you way more than doubled your profit amount, because you can now afford to have a position that is placed in a much more advantageous location. If you have an even larger balance, you can then afford to place a third position, which will then make you 1,100 points instead of just 300. You could obviously place just one buy at triple the size in your initial area here, but you'd only make 300 points of profit. If you instead create smaller positions but space them out in advantageous locations, you can turn 300 points into over 1,100 points. And what you rely on here is these small downwards moves. If you have something like this, right, you would buy, let's say, up here, right, and it goes back up to here. That's 103 points of profit. But you buy again down here, and those 103 now are added on top of 207. So now this 207 plus the 103 here, you've got like 310 points of profit. Much better than just having this be twice the size and only make 200. Because you have to realize the market will at some point drop anyway. It will eventually drop. So what you do is you simply place limit orders for buys. Oh, my fault. For buys at these different levels. You place one here, and you place one here, and you place one down here, and then you just quickly run back to this math here up until 15,000, like in our example. So we take 21,000 or 22,000 for the easy math down to 15,000. That's 7,000 points of difference. You multiply 7,000 points by your lot size to get, in this case, here we have $75, then $70, and then $65. So what we do here, we take 75 plus 70 plus 65. So that is what? 80, 140, 210. So you end up with equals 210. This means if you have a balance greater than 210 in USD, you can never lose this account. Because again, the price will never go past 15,000. If you have, or the level I believe it will never go past, right? If you now have 250, that's an extra 40 points, or an extra $40 of balance. It would need to drop down to somewhere like 13,000 for you to ever lose your account. Which means if you have a large enough balance, you can theoretically have trades that would need to drop all the way down to, let's say, like 5,000, which will literally never, ever happen. Okay, it will never happen that NASDAQ drops to 5,000, ever. Okay, so you can have a 100% guarantee that you will never lose money while being able to constantly take small profits out of the market here and there, pretty much like investing, but speed running it. Okay, this is something I call accelerated dollar cost averaging. And what I mean with that is dollar cost averaging is effectively saying like, hey, I'll buy NAS this week, then I'll buy it next week, and the week after that, and the week after that, right? The same way you would with investing. But instead, you do it based on points, not on weeks or months. So every time it drops a certain amount, like 200 points, 500 points, 1,000 points, you just simply buy again. That is about all I have for you in this video, and I'll see you in the next one, maybe.